Hey, good morning, everybody. It's just about 10 o'clock. It's 9:59 on Tuesday. That means it's time for our Tuesday weekly webinar. Good to see everyone. Okay, today is going to be our continuation of our four-part series, How to Get to Zero Tax. And this is part 3 today, and we're going to talk about pensions. So we talked about Roth IRAs and Roth 401ks and other retirement plans on our first week. And then we talked about what did we talk about? The taxable accounts last week. And today we're going to talk about pensions. And next week we're going to talk about Social Security. And we're going to follow our normal format in that we're going to have some slot updates for about 15 minutes or so. We're going to go over some market updates and analyst reports. And then we're going to get into that financial planning topic, which was or is how to get to zero tax. And that's pensions. And we call that now the Financial 15. I wanted to remind you that these sections are indexed in the description of the YouTube video if you're watching this as a recording. So you don't necessarily have to wait for each segment of the broadcast. If you wanted to just watch or listen to the slot updates, for example, but in the slot updates, a lot of people enjoy this because we talk about things that are affecting other people out there. And it's interesting because I saw an article today regarding the use of Roth IRAs for education funding. And that came out just yesterday. I'm going to do a separate webinar about that, so I don't have that to share with you today. But I've got to reach out to Ian or Andy, I think, wrote that article because I think it's in a direct response to a conversation he and I had last week. We're all, it's topics that I talk about come from conversations with you all and folks like you. And I'm certain this conversation this article that Andy wrote came from our conversation last week. But those topics are indexed. So many people like these IRA updates and retirement plan distribution updates from the Slott Group. They're very thorough and beneficial, and so many people like that. So you can just jump to that section if you just want to review what happened in the markets and what my thoughts are and what the analysts are saying about market activity. You can jump to that, and if you just want to go to the Financial 15, that's also indexed in there. So you can go back and forth, and also I think on the timeline on the YouTube bar that runs across, that also gives you the updates, because these webinars go usually about 45 minutes to an hour, and it doesn't always make sense just to listen to everything. I recognize that, but the sections are indexed for your use, and on the YouTube channel you'll also see the Financial 15 sections. And this 4-part series is going to be it's already in a playlist. So it's in a playlist in YouTube, and you can see the first section or first part, and that's Roth IRAs and Roth retirement plans. The second part, which is taxable accounts, and the third part, which is pensions. Today and next week, you'll be able to see Social Security. Good morning, Doug. Doug says good morning. So good to see everybody. So we talked about the indexing. Now, I hope you've had an opportunity to see the new website. We talked about that a couple times, but that's forever evolving, and there's just so many videos on there, and I hope you're enjoying those. And I really like it because when I'm talking to clients or new clients or prospective clients, I can just send them those videos of I think there's 170 some videos that that we've developed over the past few years since this started. So that's really helpful to me, and I hope it's helpful to you. I want to remind you that I'm really proud that I was awarded the 5-star Wealth Manager Award for the 11th consecutive year for the greater Philadelphia area. So there's a relatively small percentage of us who get that award. I don't know the exact number, but 11 consecutive years. I'm proud of my staff, and I'm proud of myself for achieving that. Big headline in the past year or past week was the ratings cut for the U.S. government. So Fitch cut U.S. credit rating to AA+ from AAA. Reuters reported on August 2nd that the Treasury calls this arbitrary. So that's a little bit, in my opinion, a real smack in the face to Fitch. If you remember, the ratings organizations were really called to the carpet back in the Great Recession when there were bonds that were highly rated that turned out to be not the components of the bonds were very low rated junk kind of bonds and bad credit quality, and that's really one of the things that caused a lot of the turmoil, the Great Recession, and a lot of the trust in these rating organizations. So Fitch comes out and says, because of not only the economic issues that we have facing us from the U.S. government point of view, but because you folks in the government can't seem to get it together and work together and come up with a strategy until the very last minute, and I'm giving some of my own color on that. We're reducing our rating of the federal government as a whole, right, from AAA to AA plus, and that of course is reflected in their bond ratings. So let me read you what Reuters says. In Fitch's view, from Fitch's statement, in Fitch's view, there has been a steady deterioration in standards of governance over the last 20 years, including on fiscal and debt matters, notwithstanding the June bipartisan agreement to suspend the debt ceiling until January 2025. And then, of course, Treasury Secretary Janet Yellen disagreed and called it arbitrary and based on outdated data. Now, I understand where Secretary Yellen is coming from a position of protecting her position in her job, and she certainly has a bias, but that's not what we're looking for from a rating agency, is protecting Secretary Yellen or anybody in the areas of government. And I think they nailed it. Fitch absolutely nailed it with the downgrade of the U.S. government. And I'm shocked at the resiliency that we've seen in the markets. We're going to talk about that a little bit since that's come out. All right, let's do our slot updates. So today we're going to talk about first inherited IRAs, and this is a common topic that we have. Inherited IRAs are very, very complex. There are many classifications of people who that you may fall into when you inherit an IRA and inherit an IRA or a retirement plan, and the rules can be slightly different, so you've got to be aware of that. But if you're following us on a regular basis, you hear this all the time. So this is by my friend Andy Ives. And you can see, inherited IRAs and RMDs, today's slot report mailbag. So the first question here is, if I have the beneficiaries of my IRA listed as my wife at 50% and my two children over 21 at 50%, is my wife still able to move her half of the IRA into her existing IRA when I am gone? Or does having the adult children as partial beneficiaries inhibit her opportunity to do a spousal rollover to combine it with her existing IRA? Well, that's from Stephen. Stephen, that's a great question. Because the ability for a spouse to treat an inherited IRA from their deceased spouse as his or her own is really extremely valuable. And you can keep that inherited IRA as an inherited IRA if you're a spouse and really change it at any time, whatever benefits you, or you can roll it over into your own IRA if that's the best situation. But there's a lot of flexibility there, except when you're potentially tied into a situation like this, where this person left 50% to his wife and 50% to children over 21. Now, here's where it's really common that we might see this is in second marriages, things like that. People will say, and planners like myself will make recommendations and say, you don't need any complex trusts or strategies like that. You may be able to do what you want to do just by using beneficiary designations. And let's say if, for example, I had a second wife and I said, I want to leave 50% of my IRA to her to make sure that she's taken care of for the rest of her life, but I'm going to direct the other 50% right to my children so that I make sure that they have what they need. That's a sound strategy, but there are some things you have to be aware of to make sure that your wife or your spouse will continue to have the flexibility of treating that as her own IRA or his or her own IRA, or that person might be stuck in a inherited IRA for life kind of situation. So let's look at the answer to this. So just like everything else, it's a little manifold and complex. So the answer is, Stephen, as long as your IRA is timely split after your death, your wife will still be able to complete a spousal rollover into her own IRA. This is often referred to as separate accounting. The deadline for your beneficiaries to set up separate inherited IRA accounts is December 31st of the year after your year of death. If that happens, your wife can do a spousal rollover. So I am right here now. There we go. I am right here. If that happens, your wife can do a spousal rollover. However, if this deadline is missed, your wife would not be permitted to do a spousal rollover and would be required to maintain the account as an inherited IRA. So clearly we have to pay attention to the rules and guidelines, and you don't want to get caught in a situation where you're missing an opportunity or reducing flexibility. Is it potentially the end of the world if she has to maintain it as an inherited IRA? Well, she could have to take distributions that she doesn't necessarily want to take. So there's just, again, flexibility is better. Could this happen? Of course this could happen. And this is why you should have extensive preparation while you're still healthy and while you're still here on this earth. It's because when your spouse passes away or your person closest to you passes away, there's a lot of emotions involved in it. And if suddenly you have to make a decision, even by December 31st of the year following the year, you may not be in the headspace for that. And many people don't make good choices, or they may not make good choices during that time. So do your proper planning and have a game plan for when the unfortunate happens. So the next question, I hope you can help me. I just inherited, and this is a bit of a tongue twister. I hope you can help me, please. I just inherited an inherited IRA from my sister who had inherited the IRA from her fiance. There were only 4 years difference in age between my sister and I, but I am unsure the age of her deceased fiance. How do I determine if I'm an eligible designated beneficiary or just a designated beneficiary? And whose age do I use to determine the RMD requirements? Any help direction you can provide would be greatly appreciated. Liz. So let me see if I can lay this out for you. Liz's sister inherited an IRA from her fiance and then passed away. And now Liz is the successor beneficiary, and she's inherited the IRA from her now sister. So it's kind of twice removed. So Andy's answer is, Liz, since you're inheriting an inherited IRA, that makes you a successor beneficiary. I will assume your sister was taking stretch required minimum distribution payments, RMD payments, from the inherited IRA based on her own single life expectancy. That's how it should have been done. As a successor, you will continue this same exact RMD schedule using the same RMD factor that your sister was using. Essentially, you will step into her shoes for future RMD payments. Additionally, since you're a successor beneficiary, the 10-year rule also applies, so continue RMD payments from years 1 through 9, but the account must be emptied by the 10th year after the year of your sister's death. So this is another common mistake. People think, okay, now I've inherited this IRA. I have to follow these guidelines. I have to now take the distributions over my life expectancy or a period of time, within that 10-year period, and they use the wrong calculation. When you're a successor beneficiary, you step into the shoes the person who first inherited that IRA. All right, and the article today comes from Sarah, and what you need to know if you name a minor child as your IRA beneficiary. So this has been completely changed since Secure Act of 2020. So I'm really glad to see this article, and this is good review. So Sarah writes, are you thinking of naming a child or grandchild as your IRA beneficiary? With the start of the Secure Act in January 2020, the rules for inherited IRAs were upended. Prior to the enactment of the Secure Act, naming a minor as a beneficiary was a good way to take advantage of the stretch IRA. A grandparent could name a young child as their IRA beneficiary, and distributions could be paid from the inherited IRA for decades over the long life expectancy of the beneficiary. The Secure Act has changed everything. If you're looking to leave your retirement account funds to the next generation, you will need to rethink your estate planning strategy. Post-Secure Act, the rules have changed when it comes to naming a minor as a beneficiary. Now the stretch IRA is gone for most beneficiaries, including minors. Many are subject to the 10-year payout rule. Minor children of the IRA owner. There is a special rule for some minors. Only caps, large caps, only minor, just in case you're only listening to this and not following along on this document. Only minor children of the IRA owner are considered to be eligible designated beneficiaries and can take required minimum distributions, RMDs, based on the single life expectancy until age 21. At that time, the 10-year rule would apply. So you take the RMDs based on your life expectancy, single life expectancy until age 21, and then you've got to lay over the 10-year rule. Or switch really to the 10-year rule. Under IRS proposed RMD regulations, annual RMDs would be required to continue during years 1 through 9 of the 10-year period, and the account would need to be emptied by the end of the 10th year. Sarah gives an example. In 2020, Lisa, age 10, inherits an IRA from her mother. Lisa is an eligible designated beneficiary and can stretch distributions over her single life expectancy. This goes on for 11 years. Lisa's 21st birthday is in 2031. Because Lisa has reached the age of majority, age 21, regardless of state law, the 10-year rule will then apply. Lisa must continue to take annual RMDs in years 2032 to 2040 and must empty the inherited IRA by December 31st, 2041, the end of the 10th year after she reached 21. I hope that makes sense to you. Makes sense to me. How about grandchildren and other minor beneficiaries? Minor beneficiaries who are not the child of the IRA owner cannot delay the 10-year rule until age 21. Let me read that again. Minor beneficiaries who are not the child of the IRA owner cannot delay the 10-year rule until age 21. Other beneficiaries such as grandchildren, nieces, and nephews are not considered eligible designated beneficiaries and would also be subject to the 10-year rule immediately upon the death of the IRA owner. If the IRA owner died before his or her required beginning date, RBD, annual RMDs would not be required during the 10-year period. Sarah gives an example of this. Kevin, age 75, dies in 2023. The beneficiary of his traditional IRA is his grandson. Daniel, age 10. Daniel does not qualify as an eligible designated beneficiary because he is not the son of the IRA owner. Daniel will have to take annual RMDs from the inherited IRA based on his single life expectancy for years 2024 through years 2032, years 1 through 9 of the 10-year period. Because Kevin died after his required beginning date, because Kevin died after his required beginning date. Remember, once it starts, it can't stop. In addition, the entire remaining inherited IRA balance must be distributed by December 31st, 2033 in that example. Okay. Alrighty, and just so you folks know, I'm going to share it one more time here, and I'm going to bring this up, and I'm just sharing some of my notes here. But you'll see that I keep a list. I've shared this with you before, but I keep a list of eligible designated beneficiaries. I actually have this on my desk because of the changes from 2020. It sometimes takes a while to ingrain it, even in myself. So I'm going to do a webinar just about eligible designated beneficiaries because the rules are complex, and it seems like they're getting more complex every single day. All right, let's go into investments in the market recap. So last week, stocks ended lower. But we're going to talk about the growth of the markets for in July. We've had it's only Tuesday. Yesterday was a big day for the Dow for sure. But anyway, after a downgrade of the U.S. credit rating, Cornerstone writes, Fitch. We talked about this. Fitch downgraded the U.S. from AAA to AA plus. Jamie Dimon from JP Morgan called it ridiculous. I talked to you about Janet Yellen's thoughts about it, but again, these folks have skin in the game here, and again, I agree with Fitch's rating on this, and I think it's timely, and hopefully it gives a wake up call to those in power in Washington as a whole, not the president, not the Congress, but everybody. There's this economic, I don't want to use the word disaster, but that's what's coming up into my head. That's just coming on us, and we have to do things to prepare for it and make changes, and to hopefully not even prepare for it, but hopefully stave it off and fix it. And we know that one of those things has to be an increase in personal income taxes. And that's going to come, and we think that's going to have to happen by 2030. But let's not get in that discussion. The U.S. continues to be viewed by investors around the world as the safest place to store funds, and that doesn't appear set to change in the foreseeable future. Energy prices have been creeping higher. This is, again, just a market recap. Energy prices have been creeping higher, with gasoline prices getting close to the psychological important $4 a gallon. This is something to watch, as higher energy prices could further crimp the consumer and filter through the economy, forcing the Fed to act more aggressively than currently expected. Last week, we talked about the ISM manufacturing report that we were expecting. The index rose from 46.4 to 46.4 from 46.0. That is the depicting contraction for the 8th consecutive month. New orders, the forward-looking component, also remained in territory depicting contraction, but rose 1.7 points to 47.3. So what does that mean? Manufacturing remains in a range that would indicate a recession, but the improvement provides some further evidence that the economy may be able to manage a soft landing. Folks, we just don't know. The markets are seeming to defy some of the economic pressures we're seeing around it. Downgrade from a well-respected organization. Stubborn inflation, even with aggressive interest rate hikes. We had a really hot jobs report from ADP. I guess it was last month, but all these things, it concerns me. It seems to take me away from the softer landing thought, but again, you've got to structure yourself. You don't want to be pessimistic. You don't want to be overly optimistic. I take the position of defensively optimistic, and that's worked well for myself and my clients for sure, because we have the growth that we need in the areas that are appropriate, and then we have the protection and the more conservative approach in the areas that where we need it for funding. And frankly, in our more conservative portfolios, we're getting returns much higher than we have been expecting. So we've got to take that. I mean, that's a positive. We talked about non-manufacturing last week. The labor report, jobs increased by a slightly less than expected 187,000, while the unemployment rate ticked lower to 3.5%, down from 3.6% the previous month. So we talked about how high the ADP payroll report was last month. This modestly softer number gives some fuel to the doves, the folks that are hoping that interest rates will stop increasing or maybe flatten out for some time. Although the hourly earnings number continues to run uncomfortably high for the Fed's liking. So this week we have the all-important consumer price index on Thursday. So we'll see where the expectation is going to be a little bit higher. The energy prices rising over the past month are going to contribute to that, and the core rate of inflation remaining elevated. This report continues to be the key to what the Fed's future path may look like. Friday, we have the PPI. All right, so let's look at this with me. Let's see if I can include you in this. This is the markets review for July. So that works. So just look at some of these. We have the Dow Jones. I'm up here. We have the Dow Jones. Can you see my cursor? Let's see. Yeah, there we are. We have the Dow Jones Industrial Average, For the month, 3.44. Year to date, 8.55. The S&P 500 for the month, 3.21. Year to date, 20.64. NASDAQ, 4.08 for the month. Year to date, 37.72. If I had 100 people, well-versed, educated, economic, investment management folks in a room on December 31st, 2022, talking about projections for the year in 2023, nobody would have guessed these types of returns. Again, that's why you have to structure yourself, have that good foundation where you've got your funding taken care of in the periods of time that you need it, or you're more conservative where you need it, but you also have growth built into your investments for the longer term. This way you don't feel like, first of all, you're missing out on things, and you really don't miss out on things when you're going to need it. And that is staving off inflation, or just being able to pass more to your heirs, whatever your objectives are. But certainly we know that things are going to be more expensive as we go forward. I was meeting with a client who was relatively young. They're in their late 30s. And we were having a discussion about the amount of money they're going to need during retirement. And they said, well, we're going to need about $10,000 a month, $120,000 a year. And so if they're 40, let's just call it 40, and they're 25 years from retirement, they were shocked at what $120,000 today and that need grows to in 20 years. And it is shocking, folks, how fast inflation, just at a modest 3 or 3.5% on average, just really things cost so much more. We were really fortunate over a long period of time that inflation was very, very low. Interest rates were very, very low. And what we're seeing today is really just a normalization of where things historically have been. But these are the returns that we see, what you see in front of you, returns for July. We can pay attention to. Again, we talked about the Dow Jones Industrial Average and the S&P 500 and the NASDAQ. Here's the bond returns. So for the month, bonds were down about 0.07%, up for the year 2.02%. Still down year over year. So 1 year means this time last year compared to this time this year. This is where most people have their bond holdings, and many people are still upset that their bonds lost money because they didn't expect bonds to lose money. I'm down in the middle now. I'm right here. You see the Fed funds target rate is at 5.5%. We know that. Prior month was at 5.25%. And just a year ago, we were at 2.5%. You can see the 6-month treasury is at 5.45. So that means to if you owned a 6-month treasury bond that's issued by the U.S. federal government, still at AA plus, the safest investment out there for sure. And now let me just also say this about the Fitch downgrade, is that Fitch didn't say don't invest in government bonds. Fitch didn't say that, the U.S. economy is shaky and it's heading into the gutter. Fitch just said you got to get your house in order, and you folks don't have the tools to do that right now because you're not allowing yourself to do it. In politics is driving everything. So for what this means is you would annualize over a year, you would earn 5.45%, because someone asked me, do I get that over 6 months? No, you don't. You get 5.45% per year annualized, but you own the bond for 6 months. Now, some people have said, well, why not if your goal over the long term and some of your investments is 4 to 6%, why not just buy U.S. Treasuries for the rest of your life at 5.5 or 5.45%? The answer is we don't expect this to maintain in the long run. You'll see up here on the right-hand side this U.S. Treasury curve. This is a typical curve should look something like this, where you get more interest. This is the interest rate over here, and this is the time that you hold that bond, what we call duration or maturity. So normally you get less interest for the shorter period of time that you own a bond, and more interest the longer you own it. What we have right now is an inverted yield curve where we're actually getting higher interest in the short term and lower interest in the long term. That's not sustainable, and it's not normal. And I don't expect that even this time next year we'll have that situation. So that's not a good option. You want to stay with your typical asset allocation, principal protection, and account segmentation. And if you don't know what I'm talking about, you should visit. I have a video called Investment, 3 Pillars of Investment Management, or 3 Pillars of Investing. I don't remember exactly what it's called, but that runs through that in detail. Okay. So they were the markets. Interesting conversation from one of the, and you can follow this too. There's a online service called Seeking Alpha, and they deliver about at least a dozen articles in my inbox every single day, including the weekends. And it's a really great resource for information. And there's a premium subscription, and there's a free, use. But I like some of the articles I get in there, and I'm gonna attribute this to a fellow named Michael Kramer. I don't know Michael. I just like the article he wrote about the consumer price index. So I'm just going to read it to you. And this came from Seeking Alpha. Again, a great resource for investment research, particularly with ETFs, exchange traded funds, and closed-end funds. So Michael writes, analysts expect the CPI, consumer price index, to rise by 3.3% year over year in July, and up 0.3% month over month, up from June's reading of 3% year over year. So just slightly over what it was in June. So coming in at 3.3% in July. This is the expectation. We won't know for sure until Thursday. So in June, it was 3% year over year and 0.2% month over month. So obviously higher. Michael writes, core CPI is expected to rise by 4.8%, however, year over year, and 0.2% month over month, both in line with June. Inflation swaps are currently pricing. Okay, so that's an investment detail. And then he further writes, the CPI reading on August 10th may carry more importance than markets are letting on. As noted last month, the June CPI report was the easiest print of this cycle and likely marked the end of the stock market's fantasy of inflation magically falling back to 2%, at least not anytime soon. So what he's saying is that, we do have this stubborn inflation, and people are seeing this falling inflation, and they're saying, okay, well, maybe we're coming back to normal, and maybe the markets are going to be okay, and we're going to hit this soft landing, or we're going to have this soft landing, and it'll be okay. My concerns lie in the not okay, right? What if we really hit this deep recession? What if we hit a strong recession? And again, I want to be defensively optimistic here. You've got to have your investments set up right in the right categories. And believe it or not, you don't let the markets drive your investment decisions. You let you have your plan drive your investment decisions. He writes, core is the bigger problem, but the real problem isn't changes in energy prices. It remains the core inflation rate. That measures inflation excluding food and excluding energy. Core inflation has remained elevated, partially due to shelter costs, but the other problem is that service inflation remains very high. Now, we talked about the increase in the jobs reports and the labor reports, and that is still stubbornly high as well. At the end of June, services inflation was 6.15% year over year, while goods inflation was 1.3%. Both are much higher than their historical average from 2000 until the start of 2020 of 2.75% and 0% respectively. So I thought that was good information and additional information about the consumer price index and not such a rosy view on what we could be experiencing going forward. BlackRock wrote a pretty substantial article about the downgrade of the U.S. government. I'll just read kind of the intro to you. The move by Fitch Ratings to strip the U.S. government of its top-notch AAA credit rating again underscores the long-term challenges we see for the U.S. fiscal outlook. We don't see this action as a market driver and see no impact on U.S. Treasury market functioning. The credit rating downgrade is unlikely to cause the Federal Reserve to meaningfully change its macro assessment, which means they don't think it's going to change how they're going to raise or maintain or potentially lower interest rates. We think nor does it change our expectations for the path of policy rates. They go on to say they expect rates to be higher for longer. Fitch's downgrade follows the debt ceiling standoff 2 months ago that brought the U.S. close to a technical default. Fitch is the second ratings agency to remove the U.S. top AAA rating after Standard & Poor's did so in 2011, following a similar standoff then. This is a very different market and macro backdrop compared with 2011 when policy interest rates were near zero, deflation risks were emerging, and the euro area was suffering a sovereign debt crisis. So they just... I'm just saying, here's their bottom line. The rating downgrade reinforces our view that rising inflation and debt burdens will prompt investors over time to demand more compensation for the risk of holding long-term government debt. We see that causing developed market bonds, so larger economy bond yields curves to steepen over time as long-term yields rise. So more normalizing of that yield curve I was talking about. This is again just BlackRock. BlackRock writes, we stay tactically underweight broad developed market stock, but are overweight on a long horizon. So that just means that they're holding stock positions for longer term, but in the immediate time, they're underweight stocks for developed markets. Okay, that is BlackRock. All right, now switching over to our Financial 15. So I'm going to share my screen and my pad. So here we are with the Financial 15. And overall, we're talking about how to get to zero tax or as close as possible. Part 1, we talked about the Roth IRA and retirement plan. Part 2, we already talked about. We talked about taxable accounts, and we talked about that last week. And if you're just joining us now, and this is the Financial 15, what you missed was about 37 minutes of market updates, for IRA distribution rules, from the Ed Slott group and some other really clever commentary. And you can find that if you want to view it on the by finding your weekly or our weekly webinar, the same title, How to Get to Zero Tax, Part 3, Pensions. This week for the Financial 15, we're going to talk about pensions. So remember the objective here. We have John and Mary. In this example, they're 61 and 60 years old. They want to retire at 66 and 65. I'm over here. Am I hiding them? Maybe a little bit. Their current income is $160,000. They need $84,000 a year after tax, or $7,000 a month. They have $43,000 in Social Security at their full retirement age. They have some goals of buying a condo, helping their daughter with a wedding at maybe age 70. And we know what kind of investments they have. They have $1 million in an IRA. They have $350,000 in mutual funds, and that was in the taxable bucket we talked about last week. They have a 401k with no match. They have some term life insurance and some long-term care insurance. And we did an analysis for John and Mary, and it is, yes, John and Mary. So, and we determined that if John and Mary are tax efficient, and again, you can go back to the first video, the part 1, to go through this in detail. But we determined, and this is not financial planning, this is a simple side-by-side comparison, that at age 85, right here, if they took the steps to be tax efficient, as opposed to just kind of following in the paradigm of tax deferred, I'm going to keep my money tax deferred. Taxes will likely be lower as I age in retirement. And I say that as the old paradigm. That is not what we believe. We believe taxes are going to be much higher in the future. But you can see the difference at age 85 to John and Mary could be $2.5 million by doing things a little differently. So just by repositioning their investments in different buckets, not spending less money, not taking more risk or anything like that, just positioning their investments in different buckets. So we went over the conversion strategy and contribution strategies of Roth. We went over funding a life insurance retirement plan for your taxable accounts, and doing contributions into Roth from the taxable accounts and the effect. And this week, we're going to talk about pensions. So pensions are great. Fewer and fewer people have pensions coming their way. But they're certainly, if you're in a government agency, you likely have a pension. Some large companies still have a pension. We have a lot of pharmaceutical companies where we live here, and there are still many pensions. We are seeing them sold off to annuity companies to help remove the liability from the large company to another large company, but an insurance company. So we are seeing that from time to time, but they offer guaranteed lifetime income, these pensions. Now, of course, there's different ways that you can receive that guaranteed lifetime income. And I talk about it here. The payment tier can be simple or complex. I've seen it kind of all over the place. The state of New Jersey, in my experience, is probably the worst. So they not only have many, many different ways that you can receive your pension, but they have different classes of employees. And if you happen to move among different areas within the state, you can be classified different ways. So that is probably the most complex. Or it can be very simple, where you have a single lifetime payment, a joint lifetime payment, what they call a period certain lifetime payment. That typically means that someone, if not you, so your payment would be lifetime, right? So lifetime for first person. And then if you passed in a period of time, let's just say you have a period of certain of 10 years and you passed in 5 years. So in 5 years, you're no longer here. Someone you designate would receive the payments for the remaining 5 years to round out the 10 years. And of course, they have different dollar amounts. Usually this is the most substantial. This typically is a little less, and this can be a little less as well. So that's a decision you have to make about how your pensions are distributed. Pensions are backed by a government entity or a company who you work for. Payment is based, so your pension payment is based on a payout factor and is sensitive to interest rates. It can be sensitive to interest rates. And this is more, the sensitivity to interest rates is more about a lump sum. And we're going to get to that. But what happens is, let's just say you've got, a value of $1 million in your pension, and your payout factor is 4, right? That means you'd get about $40,000 for the rest of your life, as long as you're alive. If you choose a joint option, it's going to be as long as you and your spouse are alive. There have been rare circumstances where I've seen it be able to go to the next generation, but it happens. Excuse me. We'll cut this out in production. So what is this PBGC down here? The PBG is the Pension Benefit Guaranty Corporation. Think of it kind of like the FDIC for pensions. A company who has a pension pays insurance premium into the PBGC. And if that company fails and can't meet its pension obligation, or there's some other reason that pension is sent to the PBGC, then the PBGC guarantees that pension will be paid out. I've seen payments coming out of the PBGC of about 25 cents on the dollar. So your payment can be greatly reduced if your payment or your pension gets sent to the PBGC. So be aware of that. What we're talking about today, so they're kind of the basics of pensions, and they can be very, very good. Guaranteed lifetime income is a great thing, right? You can't outlive this. It helps with the planning, right? If we know that a client is getting $40,000 a year come hell or high water from the time they turn 65 until their time they're no longer here, that takes a lot of pressure out of the plan. That allows for a different investment approach, and it can be a very, very good strategy. And what I learned in the back in the day of my transition right into a tax efficient planner way back in 2012 is that the problem with pensions is that they are forever taxed. And the thing is, very few pensions these days have a cost of living adjustment. So if you have a government pension, you likely have a cost of living adjustment, but you may not. Teachers' pensions here in Pennsylvania probably haven't seen a cost of living adjustment in 20 years or more. And that's a government pension, but there has not been an increase. But certainly they are forever taxed. So as tax rates go up, less and less of your pension will be a spendable amount of money to you. So in this example, $40,000, if you're at a 10% tax rate, you're only giving up $4,000. If suddenly you're at the 40 to 45% effective tax rate, well, it's much more. So there's less money you have to spend. Couple that with inflation, it can really be an issue. So from a tax planning point of view, what are the alternatives? Tax planning. Well, figure out if you have a lump sum option in your pension. Sometimes you do, sometimes you don't. If you do, they may say, okay, let's use this $1 million. Okay, you got $1 million available to you. Now, I'll tell you, interest rate sensitivity. I saw last year while interest rates were rising, $1 million becomes 900,000. 900,000 becomes 800,000 as interest rates are going up. Why is that? Because as interest rates rose, there was less money needed to affect the same payment amount. So if in this case, the company is saying, we're going to guarantee you $40,000 a year, and that was when interest rates, let's just go back to what we saw, 2.5%, at the Fed funds rate. That's not really what they use, but let's just use that as an example. And now all of a sudden that is at 5.5%. Well, you need less money on this side to generate that same $40,000. So that's where your lump sum can be affected. But let's go back to the million. So let's just say you have $1 million lump sum, and or you get $40,000 a year, and you know that $40,000 a year is going to keep you from being in a very low tax bracket or the zero tax bracket, but it's also going to expose you to erosion of that $40,000, not just because of inflation, right, but also because of tax. Because again, if you think that you're going to come in paying 10 or 20% in tax on that $40,000, and then by the time 2030 or so comes around, you're now higher than that. And we believe that your average middle-class American is going to be the 40 to 45% effective tax rate. Then less of that $40,000 is going to be yours to spend, and more is going to go to Uncle Sam. So how do you overcome that? Well, if you have a lump sum option, you can roll that lump sum over to an IRA. Now, this is really important because you might get the wrong person on your call when you call into your HR department and say, hey, can you tell me if I have a lump sum option? Because that's your first question. Contact your pension provider and say, do I have a lump sum option? And if they say yes, say, how much is that lump sum option and at what age? Because you might be 60 years old and you may not be able to take that lump sum until you're 65 years old, even if you're not working for the company anymore. That's possible. But let's just say you're still working for the company and you plan to retire at age 65, and they say you can take $1 million projected today at age 65. And you say, that's great. Well, at the time, I'm going to want to roll that to an IRA. And they might say, okay, yes, but you'll have to pay, we have to withhold 10% tax on that. And that's red. That's a buzzer. You do not have to pay tax on a pension lump sum rollover as long as it's done correctly. It's really hard to do this incorrectly. Of course, we've seen it done, but what you do is you treat it just like a 401k rollover. But I will say this, and I've said it to people, and we still get the coaching from these organizations, and sometimes even good ones. Even with a 401k rollover, well, we have to withhold 10% on that. You do not. There is no, if you get that recommendation or that advice from somebody on the other side of the phone when you're doing a rollover from 401k or a pension rollover from your lump sum pension rollover from your provider, just ask to speak for another company or another representative. I've even had people hang up and we'll call back because that is incorrect information and you're dealing with the wrong person. So you treat it like a rollover. So the $1 million gets issued in a check made out to your IRA directly and deposited into your IRA. No, not a taxable event. Now that money lives inside of your own IRA. Now, what do you do with it? Well, you can have a planned conversion strategy. So now let's look at we've got a lot of stuff going on in here. Let's look at our buckets. Remember, you've got your taxable bucket. We talked about that last week, so I'm not going to go over that again. You've got your tax deferred bucket. And then you have your tax-free bucket. And last week we talked about, the first week we talked about Roth. Last week, we talked about cash value life insurance, or what some people call a life insurance retirement plan. But today we're talking about pensions. So basically, you end up with your pension sitting in this tax deferred bucket in an IRA. So now that $1 million sits here. Now you can say, all right, over the next X number of years, I'm going to transfer that $1 million from my tax deferred, my traditional IRA, to my Roth IRA. And yes, I'm going to pay tax on that transfer. And let's just say, to keep it easy, you move $150,000 a year. And how do you determine that $150,000 a year? Well, as I said before, you do a calculation based on the tax that you want to pay, the tax that you're willing to pay for that conversion. And you get to choose that as we sit today under the rules. You get to choose that tax by filling up that. I'm not going to draw it again. It's over here somewhere. Let me find it. Here we are. You get to fill it up using this kind of, David McKnight refers to it as a graduated cylinder. You figure out how much you want to convert that builds up into your tax bracket. We typically recommend up to the top of the 24% bracket, but sometimes it makes sense to go a little bit further than that. But that's an individual decision. So you figure out how much of that pension you want to convert to a Roth IRA, and you choose your tax rate. And you can still do that today. So let's find our buckets again for today. Where do we go? All right. So if we did $150,000 a year, factor in some growth, maybe you're done in 8 years. Now that $1 million plus some growth, so maybe it's let's just use the same number. $1.5 million sits over here. Well, that's great. You've paid your tax along the way. Now you've got your $1 million over here. Let's not be as aggressive with the growth. Let's say, let's just call it 1.2 million. That's fine. It doesn't matter. It may grow by 50% over that period of time. Yeah, it certainly could. Yeah. So, okay. Or 1.5 million. Who cares? This is just an example. So 1.2 or 1.5 million, whatever that growth is, now that comes out. And what's the tax rate on that? That tax rate is 0. But wait a minute, Mark, doesn't matter. Now that's subject to market fluctuation. You just said it could be 1.2 or 1.5 million. I could start with 1.5 million. It could go to 1.2 million. You could create your own lifetime income pension. You, of course, want it to be tax-free. Ideally, you want it to live in a Roth. You can start in an IRA, and you can transfer it via conversion to a Roth IRA. But now you own that pension. You have responsibility for it. You can structure it how you'd like, and you can now have tax-free income. So it's not going to be, it's still going to be subject potentially to the erosion of inflation, but certainly not for tax. You know what the tax rate you paid. You've locked in that tax rate for the rest of your life, plus 10 years actually. So the rest of your life plus at least 10 years. So if you pass that to a non-eligible designated beneficiary, remember they have to distribute that by the end of 10 years. So you've locked in your tax rate for the rest of your life plus 10 years under the current rules. So if you wanted to recreate your own pension, what you would do is you take this $1 million that you start with and you put it into an annuity platform that allows for, this is very important, that allows for Roth conversions. Now, my friend David McKnight calls these piecemeal Roth conversions, which means you could take a portion every year and convert it and still stay within that annuity contract. The benefit of the annuity contract is that it should have guaranteed income, guaranteed lifetime income. Now, ideally, you also want the ability for that income to increase. So ideally, you'd look for a platform that has not just guaranteed lifetime income, not just the allowance of Roth conversions over a period of time, but also the ability for income to increase. And there are those companies out there. I'm not going to talk about the details right now, but that's how you set up your own pension that is tax-free, guaranteed for life and all that. And you still have the same options. You don't have the multitude of options that you have in a pension. Sometimes you can, if you're married, you can have these distributions, these guaranteed distributions being over a single lifetime. or joint lifetime, whatever works for you. There can also be death benefits involved and long-term care provisions involved, things like that. But in the simplest form, you want to take control of that pension, and you want to move it from forever taxed to never taxed or never taxed again. You want that guaranteed lifetime income to be in place, and you're kind of just replacing something that is going to be, again, forever taxed with something that is going to be never taxed again, but you have that guaranteed lifetime income. Again, make sure you have guaranteed lifetime income. Make sure you have the ability. Here it is. Possibility of increasing annual income. Very, very important. But pay attention to fees. When you're talking about annuities, you have to pay attention to fees. Ideally, you want the fee to be 0% or very low. There are those out there, again, devil's in the details. You have to look at the details of it. But that's where we are. That's how you handle a pension. And if you effectively transfer that pension over to your Roth IRA, then of course anything that comes out of there is zero tax. Now, if we look back on what we did last week, we go over here. So let's build our case here. We had we started with Roth, so we transferred our IRA, and we have our Roth, and we have our LIRP, or cash value life insurance. And anything that comes out of the Roth up here on the right, or whether it's down on the left, I'm moving you around all over. I apologize. This board's getting complex as we go through this. There you go. Here's our first step. We convert it into the Roth. Again, that's 0% tax. We may be able to leave a balance in here in the IRA depending on the individual. Certainly not if you have a pension. So this will help. If you have a pension and you convert it to a lump sum, you may be able to leave a portion of that in the IRA and pay no tax. And if that's the case and you don't pay any tax out of the traditional IRA, we made some adjustments in the taxable bucket here where we move that over to a cash value life insurance policy or life insurance retirement plan. Any distributions out of that cash value life insurance or life insurance retirement plan, as long as they're structured properly, are 0% tax, whether it's a death benefit, whether withdrawals that you use during your retirement years or for long-term care. So we have zero tax out of your IRA. We have zero tax out of your Roth. We have zero tax out of your life insurance. So the only thing that's left, folks, so 0 here, 0 here, 0 here, is Social Security. Social Security, as you can see over here, I'm going to give you a little preview for next week. Can you see that? I want to make this a little larger. This is what's called the provisional income calculations. These calculations and these brackets have not changed in many, many years. I'm not sure the last time it was changed, but they do not change. They're not based. They're not adjusting for inflation. So if you're married filing jointly, if you're provisional income, we're going to talk about what that is next week, is over $45,000 or $44,000, $44,000, up to 85% of your Social Security is subject to tax. If you're a single filer and you're above $34,000, up to 85% of your Social Security is subject to tax. And next week, we're going to talk about how to tackle that Social Security taxation. Whew. Okay. So we've said a lot. We've covered pensions. We've covered taxable accounts. We've covered IRAs and Roth IRAs and retirement plans, and we are at the end of our time today. I hope that was beneficial. I hope you learned something today. Watch this series again if you have questions. If you have questions, you can first of all look at our videos on attleborowealth.com, so you find it under education and resources. And if you have questions, you can email us at questions@attleborowealth.com. If you have questions or you want to schedule time with me, you can do so by emailing questions@attleborowealth.com. Again, I hope that was really helpful, and I hope this builds on your knowledge base. And that's it for this week. We'll see you next week, right back here Tuesday morning at 10 o'clock. Have a great week, everybody. See you soon. Bye-bye.